had a look at fundamental analysis, and now we turn our attention to my favorite topic, technical analysis. I'm a full-time day trader, and every moment of the day I will be relying on my charts to define my entry and exit criteria in the market. And it doesn't matter whether I'm trading forex, gold, oil, or even shares. I'll be talking you through some of my favorite trading setups later on, but for now, we'll have a closer look at the fundamentals of technical analysis. Despite all the components that make up what we today know as technical analysis, there really only are four core elements. There's price, there's time, then there's volume, and finally there's momentum. Now, the first one, price, that's considered to be the be-all, end-all of the markets. That's the only truth there ever will be, the current price. So if you ever watch CNBC or Bloomberg and you listen to someone saying that a stock of so-and-so will reach such and such price, just remember, it is their opinion and nothing else, and the only thing that matters is the current price. Time is another important topic which very few traders ever consider as an analysis tool to take into consideration when trading. Volume is another tool which is considered an immensely important tool in many traders' analysis. You may have heard analysts say that big moves require big volume to make the market move, but that is actually not my experience. If you look at how bull markets or bear markets start, they often start on very, very little volume and they'll finish on big volume. And finally, there's momentum, which is an incredibly important tool, at least in my own trading. It measures the velocity of the price move, and later on I'm going to show you how I use momentum in a short-term trading strategy. When a CEO is interviewed on TV, or he and she states that the current share price undervalues the company, they're really showing the ignorance about how the market and the market forces work. You cannot argue with the market. It's non-negotiable. The price is the only thing that matters. There's not such a thing as a cheap stock, and there's not such a thing as an expensive stock. There's just equilibrium in the market. There is just demand and supply. Remember that, and remember it well. Because eventually you're going to find yourself in a situation where you think a stock you want to trade has gone too far. But there is no such thing as a stock gone too far. Do not confuse the top of your trading monitor with support or resistance in the market. A stock will go as far as there's demand or supply. And one of the legends of technical analysis once said that there's no stock too expensive to buy and there's no stock too cheap to sell short. We'll be looking at price and the laws of price action shortly, but before we do, we need to have a look at the characteristics of trends. In particular, major trends that last for months and months, if not even years. Once a trend has established itself, it takes considerable power and time to turn it around. Primary trends are visible when the market is upwardly or downwardly mobile, and these trends, often referred to as bull markets or bear markets, can, as I said, last for several years. So while you will inevitably experience both good days and bad days within a bull market or bear market, the overall trend is either going in an upward move direction or a downward move direction. A major trend rarely reverses without warning signs, and the warning signs are increased volume activity, or a volume and or a price spike. The signs can also even be such a loss of momentum followed by a period of sideways market. But once the initial trend reversal is complete, a decrease in trend volatility tends to follow. A strong trending market slowly eats away of the overhead supply, or as it is in the case of a downtrend, it steadily deteriorates the price. Trends tend to begin after a market has reached an extreme, either to the upside or to the downside. And those extremes, also known as points of support or points of resistance, illustrate areas in the market which provide a possible indication of the future direction of the market, either up or down. And market participants are very likely to act on this information, which will in itself partially influence the market direction. I remember during the bear market of 2000 to 2002 how CNBC reporters would take a camera to the street at Times Square and they would interview people who had lost a significant amount of their wealth having invested in .com stories. And I think it's very easy to say to ourselves, or we can pretend that we have reacted differently if it was ourselves sitting with a stock that had lost 80% of its value in a year or less. But unfortunately, it's more likely that we'd have uttered those words like the young man who said about Amazon.com. Amazon.com is a good company and it will turn around. It has to turn around. The bottom line is that a stock doesn't have to do anything. A stock will do whatever it will do. Demand and supply will dictate that. And as you venture into the world of trading, it is a good idea to know those facts before you start putting your money on the line. The hardest game to learn is to learn to control your emotions when trading. It would simply be wrong to run a course on technical analysis without telling the story of its origin. Aside from Japanese candlestick trading, which can be traced back thousands of years, the real rule-based foundation to technical analysis was laid around in the 1900s by Charles Dow. Today, Dow Theory remains the foundation of much of what we know today about technical analysis. Dow Theory was formulated from a series of Wall Street Journal editorials authored by Charles H. Dow from 1900 until his untimely death in 1902. And those editorials reflected Dow's belief on how the stock market behaved and how the market could be used to measure the health of the business environment. And much of what we know today as technical analysis has its roots in Dow's work. And for this reason, we'll now cover the basic tenets of Dow Theory. The basic premise of Dow Theory states that all information, past, current, and even future, is already discounted into the current price and reflected in the price of indices and individual stocks. This information includes everything from emotions of investors and inflation data, interest rate data, to pending earnings announcements to be made by companies after the market closes. Based on this tenet, the only information excluded is that which is unforeseeable, such as natural disasters. But even those risks are to some extent already priced into the market. Like mainstream technical analysis, Dow Theory is mainly focused on price. The two differ in that Dow Theory is concerned with the movements of the broad markets rather than specific securities. An important consideration for Dow's theory is to distinguish the overall direction of the market, and to do this, the theory uses trend analysis. According to Dow Theory, there are three main types of trends. You have the short-term trend, you have the intermediate-term trend, and then you have the long-term trend. And the long-term trend, in this respect, are trends that last for years. Trend analysis attempts to predict a trend, identifying opportunities to ride the trend until the data suggests that it has reversed. But before we can get into the specifics of Dow Theory trend analysis, we need to understand trends first. It's important to note that whilst the market tends to move in a general direction or trend in a general direction, it doesn't do so in a straight line. The market will rally up to a high, we'll call that a peak, and then it will sell off to a low, we'll call that the trough. But it will generally move in one direction. An upward trend is broken up into several rallies, where each rally has a high and a low. For a market to be considered an uptrend, both lows and peaks must be higher than those experienced in the previous rally. A downward trend is broken up into several sell-offs, in which each sell-off also has a high and a low. And to be considered a downtrend in Dow terms, at least both lows and peaks must be lower than those experienced in the previous sell-off. Now that we understand how Dow Theory defines the trend, we can look at the finer points of trend analysis. Dow Theory identifies three trends within the market. There's the primary trend, secondary trend, and then finally there's the minor trend. A primary trend, which we briefly discussed in earlier chapter, is the largest and strongest trend lasting for more than a year. Secondary trends, on the other hand, extend between 3 weeks and 3 months, and they're often associated with a movement against the primary trend. Finally, minor trends typically last less than 3 weeks. These are associated with movements in the intermediate trend. In Dow Theory, the primary trend is the major trend of the market, which makes it the most important trend to ascertain. This is because the overriding trend is the one that affects movements in stock prices. The primary trend will also impact the secondary and minor trends within the market. Dow determined that a primary trend will generally last between 1 and 3 years, although this can on occasion vary. Regardless of trend length though, the primary trend remains in effect until there is a confirmed reversal. For example, if during an uptrend the price closes below a previously established low point, it could be a sign that the market is now headed lower rather than higher. When reviewing trends, one of the most difficult things to determine is how long the price movement within a primary trend will last before it reverses. The most important aspect is to identify the direction of this trend and to trade with the trend rather than against the trend. You should not trade against the trend until the weight of evidence suggests that the primary trend has reversed. In Dow Theory, a primary trend is the main direction in which the market is moving. Conversely, secondary trend movements tend to oppose the primary trend by moving in the opposite direction but still keeping the trend intact. This may simply be a correction to the primary trend. For example, an upward primary trend will be composed of secondary downward trends. This is the movement from a consecutively higher high to a consecutively lower high. In a primary downward trend, the secondary trend will be an upward move or a rally. Sometimes this is referred to as a bear market rally. This is the movement from a consecutively lower low to a consecutively higher low. This correction is evidenced in the chart image shown on the screen now. Notice how the short-term highs fail to create successively higher peaks, suggesting that a short-term downward trend is present. Since the retracement does not fall below the previous low, traders would use this to confirm the validity of the correction within the primary trend. In general, a secondary or intermediate trend typically lasts between 3 weeks and 3 months, while the retracements of the secondary trend generally ranges between 1 and 2/3 of the period of the primary trend movement. For example, if the primary upward trend moved the Dow Jones Industrial Average from 10,000 to 12,500, the secondary trend would be expected to send the Dow Jones Index down by some 800-900 points to somewhere in the 11,000 region. Another important characteristic of a secondary trend is that its movements are often more volatile than those of the primary trend. The last of the 3 trend types in Dow Theory is the minor trend, which is defined as a market movement lasting less than 3 weeks. The minor trend is generally a corrective move within a secondary move, or those moves that go against the direction of the secondary trend. Due to its short-term nature and the longer-term focus of Dow Theory, the minor trend is not a major concern to Dow Theory followers. But that doesn't mean it shouldn't be of a concern to you. This doesn't mean that it is completely irrelevant. The minor trend is watched within the large picture in mind, as these short-term price movements are an element of both primary and secondary trends. And as short-term traders, very often our focus is on those minor trends. Most proponents of Dow Theory focus their attention on the primary trend and the secondary trend, as the minor trend tends to simply be too noisy for them. If too much focus is placed on minor trends, it can lead to irrational trading because traders become too distracted and too focused on the short-term volatility, thereby losing sight of the bigger picture. Stated simply, the greater the time period a trend comprises, the more important the trend. And this, in a nutshell, is Dow Theory. As you will learn in this course, it can be immensely profitable to trade the minor trends. And it would be wrong to say that you simply focus on the primary and secondary trend. And as a private trader, almost all my time is spent on the minor trend. And most day traders and swing traders focus on the minor trend.